Good afternoon. So my name is Christophe Longeville. So I'm part of the Solventure team, and together with Gillian de Strate, we will zoom in today on the inflation topic, mainly how to deal with this rising inflation wave currently and the price challenges that you are facing in almost any industry currently. So we have the following agenda. So as I said, we will focus on inflation and how to deal with that. That comes later. First of all, we would like to give you a 5 minutes introduction on our data-driven leading indicator services, because these are one of the ways to deal with the analysis of the inflation risk, and also deal with the analysis of dashboards and tools that can help you to monitor the evolution in your value chain. So if we can go to the next topic. So let me summarize quickly what is the Solventure Life service all about. It all starts with a very big substantial database of approximately 10 million indicators, so that we source from different public databases, so such as the Fed in North America, but also in data coming from public sources in Canada, South America, Africa, but also from the National Bureau of Statistics in China, and of course elements coming from the European Central Bank and from Eurostat in Europe. So what do? We typically will mingle public and external data and your internal data into a service that can help you in better understanding the drivers of your business. Typically, we will do that on 3, 6 to 9 month horizons. So you're talking here about tactical insights of your business. And we use the concept of leading indicators, because we use indicators that have a predictive value, so that can help you look into the future. More on that in the next slides. We do that with our team of data scientists, but also economical experts. So I'm here with Gillian, who has a PhD in this topic. And so he will tell you all about what is currently the inflation risk we are facing. So if we go to the next slide. So here we have shortly summarized the benefits of this leading indicator forecasting service that we have developed. You see typically on the top of the slide here on the right hand side, what traditional forecasting solutions do is they have only internal data at their disposal. That is in contrast with what we do with these external indicators that we will identify for your business. Traditional forecasting methods will extrapolate what is happening in the past, but without not so much knowledge about what can happen in the future, because it only has that internal information of the target phenomenon. And you see that if you have inflectional bending points, these methods are incapable of predicting in what direction the phenomenon that you want to model will go. With leading indicator forecasting, we can do that, and as I said, we can do that with typically horizon of, let's say, 3 to 9 months. And the leading element, you see it illustrated on the bottom of the graph here. You see the dotted line, which is the original leading indicator. It has typically a lag, a lead difference of a number of months, and that can be 3 to 9 months, can in ideal situations be a little bit more, and that will be a very good indicator, of course, if you can identify it for future evolutions of your target phenomenon, be it a cost or a revenue. In general, we use a number of indicators, so not one, but it varies between 2 to 5 or even more, so to capture the drivers of your business. So we have still one slide and on the leading indicator forecasting. So we do that in steps. As I said before, we have the data sources coming from public data that are available, so in Eurostat FRED, but also from sources that are specifically developed by service providers, such as LMC for the automotive market, ICS typically for the energy industry. IHS is also one of these service providers we are having access to. And then, of course, we use your private data. Together with these data, we will do an intelligent matching process. So where we will combine expert input, because that's still a very relevant thing to do, but also, of course, matching engines that we have developed to be able to identify the suitable indicators that have an explainable predictive value for your business. And it's not just your business, it will always be a kind of a business unit, because the drivers, they are of course not generic. It will be different for automotive, healthcare, construction, or any type of business you would be involved in. Once we have these indicators identified, we will build predictive models. It's here, forecast modeling. These predictive models, we build them based on our own proprietary techniques, and we do that typically in a number of steps, so to find the optimal model that will be most suitable for your business. The next step, and a very interesting step, is that once we have the indicators and the models developed, we can go much further and start to develop business scenarios. How do we do that? We will make simulations, example given, of the leading indicators that we have identified, and we will include them in the models, the predictive models, so that we will be able to lengthen, to increase the horizon, so even to 18 months or longer, and that will allow you typically to better anticipate on future evolutions. Consider the services that we develop as a kind of a data expert next to your own experts, be that in sales or in any type of other department, in logistics or in your traditional operations. But what we do is bring you data-driven decisions and experts next to your own expert knowledge you have available in your company. So I will give now the word to Gillian, who will start with the current, let's say, origin and impact of the inflation wave that we see, and then further how to deal with that with our data-driven approaches. So Gillian, please, the floor is yours.
Yes, thank you, Christophe. I think everybody knows a story about inflation. My own story is actually coming from my grandparents, who told me that when they were young, a loaf of bread costed like 10 euro cents or something like that. Whereas nowadays, if I go to the store, typically that same loaf of bread would cost me over 2 euros. We're seeing that definitely the price increased over time. In this example, we're seeing a similar evolution for coffee. So we see that in 1970, a cup of coffee costed 25 cents, whereas in 2019, that same cup of coffee costed $1.59. So that means that if you had the same amount of money 50 years ago, actually, then you could buy more than 6 cups of coffee with the same amount of money that we can buy now. So that's a result of that phenomenon called inflation. So what exactly is inflation? So the definition of inflation is the rate at which the value of a currency is falling, right? So that means that the general level of prices for goods and services in general are rising. Typically that's measured by central banks. Central banks make indicators called consumer price indices. And what they do in those indicators is they include several types of goods and services in a basket. and they track the price evolution of those goods and services. It typically does not include all types of prices. For example, they tactically left out hosting prices out of that index. And typically they also report them with and without energy and food prices, because those prices are in general very volatile. There's three different types of inflation. So we have the demand pull effect, which is the effect of when there is a very high demand for a limited supply. So that typically drives up the price and leads to inflation. We can also see cost push effect. So cost push effect means that if your input prices increase, that will also lead to inflation. And there's also a part called built-in inflation. So built-in inflation, that's regular inflation, which is being strived to by central banks and so forth. So why is this inflation suddenly an issue? Well, if we look at the consumer price index, for example, here in the United States, and we see that in December, the consumer price index reached a staggering 7%. So that means that over the course of 1 year, life has become 7% more expensive than compared to 1 year ago. So historically, that's actually quite a high number. If you look backwards to the 21st century, we didn't really see such an inflationary environment over the course of the past 22 years. And in fact, we need to go back to the early 80s, to the Great Inflation period, to go back to similar levels of inflation. So that's quite staggering. In the Eurozone, we see a similar effect. And so in December, we reached 5% inflation in the Euro area. And also that is a very high value, which we haven't seen in this century. So the indicators are showing that we are entering a very high inflationary environment. So in fact, we've seen on the indicators that we haven't seen such high inflation over most of our careers, probably because we have to go back 40 years to see similar levels of inflation. But why should we bother, and how can it impact our companies? So right here, we made a list of all the terms that might impact our company, which are linked to inflation. So there's impact of monetary policy, there's impact of cost increases of raw materials, energy, staff, and COVID and transportation related cost increases. We're also looking at import and export changes. And what's also very interesting is if we look to value chains of companies, we can see also several effects occurring there. So first things first, let's start with monetary policy. So monetary policy, that's the policy which is made by central banks. And typically those central banks, they have a dual mandate. So the central banks, they will try to keep employment at a maximum level, but they will also strive for a certain inflation number. So the Eurozone and the US, they have an inflation target of about 2%. And this is actually considered an optimal number. 2% stays away from the very high inflationary environments, reduces also the risk of stagflation. And it's high enough to also stay away from the deflation. So deflation is very dangerous for countries because it really postpones consumption, as consumers know that they will get to buy more amounts of goods with the same money later in time. So typically, central banks will strive at that 2% inflation targets. To reach their dual mandates, central banks have two tools at their disposal. Interest rates and asset buying or selling. So what's currently the impact, and also previously, so during the Corona lockdown, central banks had a really loose monetary policy in which they were reducing those interest rates and doing massively asset buying programs in order to maximize the employment levels. However, now they are seeing that employment has sufficiently recovered, and they are also seeing that inflation is significantly above their target. So they will need to remove those tools to reduce the impacts of, for example, asset buying. They will also reduce or increase even interest rates in order to slow down the economy so that the economy doesn't overheat. So that should reduce inflation. And what it also impacts is it increases the costs of loans for companies. So getting money to fund stocks or fund operations will become more expensive, most likely in the future. If we then look at cost increases, right now we're looking at the producer price index. So producer price index is an index that calculates the average movements in selling prices from domestic production. So it's still different from consumer prices, is what the consumer observes. If you look at the producer price index here for commodities, they're basic raw materials and resources typically used at start of supply chains. So those have really seen a massive increasement over the past year. So we're really talking about the number here of 20%. So 20% more expensive to sell those commodities, or commodities will be 20% more expensive. If we then look over the whole value chain of manufacturing, we see that cost increases of those commodities and other goods, of course, they have really lifted the producer price index for the total manufacturing industry. So here we see that producer price index of total manufacturing has also substantially increased and is reaching a 15% increase compared to last year. So we don't only see a very high cost increase in raw material prices and or intermediate goods. We're also seeing a strong impact on energy prices. So energy prices are in part also a very large part of the inflation outbreak we're seeing. Though they're actually very important for both consumers and industry, right? So consumers use energy to heat their homes, for transportation and driving their cars and so forth. Industry, it's also really important, and logistics costs are strongly linked to energy prices. Several raw material prices are linked to crude oil prices. And also, if you're in an industry that requires tremendous amount of energy, for example, a steel industry or glass production that have these big furnaces, then they are also very susceptible for energy swings, energy price swings. So what do we see here? Remember, during the COVID pandemic, we saw a really low energy price. However, we even saw negative prices during the initial phases of the COVID outbreak. However, if we look now at the crude oil prices, we see that they have really increased. A barrel of oil this morning was almost hitting $90 for a barrel. So you would say that, or you could say that it has really drastically increased over the past year. So this is also a supply and demand imbalance. The demand for energy and oil remains very strong, even with the restrictions, for example, related to international travel. It remains really strong. However, the supply still is more difficult to switch due to years of underinvestment. If we then look at, for example, at European natural gas prices, those are really at a very high value, and it's factored 4, I think, compared to last year, which are very high due to a combination of those geopolitical tensions we're seeing. Also very low inventories. Inventories are near their 10-year low in Europe of natural gas. And also supplies have been lower than usual currently. So that's a very dangerous environment and leads to really high gas prices. So we're seeing a multi-year high there as well. Also, electricity prices have followed suit. So we see that electricity prices have generally also increased across the board. And that's gonna be the results of a concept that's called Greenflation. Yeah. So Greenflation is a concept that tells if you're looking for a greenification of your economy, and that can lead temporarily to very high energy prices and very high raw material costs of several goods. So what's the rationality behind this? So the growth of our economy, of course, requires energy for transportation, for production, for raw materials, maybe. But in general, it requires a very large amount of energy. However, in the past years, governments have been closing CO2 intensive power generation plants, for example, coal. Also, several governments have closed nuclear facilities. So this actually, on the supply side, has led to a reduction in the available capacity. There has been a big effort by those governments also to increase the sustainable power generation. However, the increase is not sufficient to offset that reduction. And it's also very intermittent power production, right? So if there's no sun or there's no wind, then there will not be a lot of production. So one of the solutions is, of course, to increase the production of that green energy power generation capacity. However, that will lead to increased demand for those raw materials. Raw materials of batteries, of windmills, solar panels, and e-cars will continue to structurally increase because the supply of those raw materials is limited. And as we see in Europe at the moment, we currently are seeing very high energy prices. Spot market price is typically based on the gas price because that's the type of energy that's available, which is currently very high. And that's together with the CO2 emissions leads to a very high inflationary environment. One potential solution could be more investments in the storage of energy. However, that's not currently readily available, of course. So that greenflation effect, we're really seeing that in, for example, prices of lithium. Lithium prices have really skyrocketed over the past year due to, and that's one of the main raw materials which are needed for batteries. If we then look at the demands which we need of clean energy technologies in the next 20 years, and we see that we still need quite a lot of investments in green energy to reach our sustainability goals. So that will be a very interesting evolution on how that will develop in the next coming years. What we're also seeing currently, and that's what we're seeing, it's called the Great Resignation or the Big Resignation. So what we see is that, well, in the graph below, that's during recessions, which are the gray areas here. Typically, we see that the red line, the layoffs, increase during recessions. And during the COVID outbreak, it was more extreme because a lot of those industries were simply closing down, which left a lot of workers at home under government spending programs. And when you're at home, you of course have more time to think about your career and your long-term goals and your working conditions. Typically, what you see after a recession is that there is a high level of job openings and hires. So that you can see hires is the green line here. That's currently very high. Also the quits, and so people just quitting their jobs, also very high. And we argue that inflation could also be a factor there. So if you see that your purchasing power has decreased by 7%, or inflation has reached 7%, and you're not seeing similar increases in your wage, then actually you're losing your purchasing power. So we think that that is actually also giving workers another push out of the door if they can get a higher wage elsewhere, which retains their purchasing power or increases their purchasing power. They will, of course, do that. Another factor impacting is still COVID and transportation issues. So there's currently a lot of supply chain issues going on across the globe, which are in part due to COVID, in part due to other factors. So there's still several lockdowns. For example, China is still striving for a zero COVID policy. And if there's an important industrial or shipping region in China seeing a COVID outbreak, and that region will, for example, go into lockdown. So if that region is going into lockdown, that of course is a panicking effect for supply chains that require goods from that region. So there will be definitely an impact there. We're also seeing longer shipping durations, and that's very visible here below in the shipping rates. Typically, those rates are very demand-driven because the supply of ships typically takes more than a year, building a ship from scratch. So it's a very demand-sensitive price setting, and really those shipment price indices are also at all-time highs. So it's showing that those shipping durations are also highly impacting supply chains. And we're also seeing driver shortages. Of course, those shipping issues, they also have an impact on those transportation issues, and they further impact the inflation problem. An interesting indicator you can follow here is the global supply chain pressure index. So this one combines components of the PMI index, such as delivery times, backlogs, and stock levels, with transportation costs of shipping and air freight, so that you can see, or you can follow evolutions in one central indicators related to those supply chain pressures. So inflation can also drastically impact demand and competition in markets. So what we know from basic economic laws is that if there's high inflation, that will lead to a weakening of your currency. If you have a weaker currency, then you will stimulate exports and make imports more expensive. And vice versa also, if you have a strong currency, then you will attract a lot more imports and reduce the interest for exports. And then as a final impact, it's very interesting to monitor what your position is on the value chain of your company. So what's actually very interesting is to see what's the bargaining power of your suppliers and of your clients. So if you're a small player, for example, that delivers goods to a big retailer and has to buy raw materials from a very strong industrial conglomeration, then you might be in for a price or a margin squeeze, in which your suppliers are pushing their price increases onto you, but your customers are saying, okay, we don't want those higher prices. So that might be eating into your margin in the next couple of months. So that's what I wanted to tell you about inflation. Now the question is, what can you do about it? There we of course offer some solution that might help you to mitigate that impact. So what we propose doing is you can map out your value chain, and across the value chain monitor demand and production evolutions, monitor inventory evolutions, monitor price evolutions. It could also be interesting to monitor order evolutions, for example, if that's available. And for that, we propose actually to use the concept of a proxy. So in this value chain, we have summarized the value chain for automotive producers. So we have upstream suppliers that supply goods for a tier 1 supplier. That tier 1 supplier makes parts that go into vehicles, and those vehicles are typically sold via dealerships to consumers. So what we know here is that the vehicle manufacturers, they have the most amount of power in that value chain. They typically have a lot of power over their tier 1 suppliers because they can threaten to switch suppliers. They also push out inventories to their suppliers via the just-in-time mechanism. They also have a lot of power on the car dealerships because they decide who gets cars. And for example, a situation like right now where there's a limited supply of vehicles. Now, what's really interesting is, especially if you're really upstream on the supply chain, like for example, a tier 1 or an upstream supplier, then you can actually monitor the evolutions in the supply chain by looking at proxies. So proxy we define as an indicator that captures the behavior of an unobservable or immeasurable variable. So here we define the following proxies. For the sales between the dealership and the consumer, we say that vehicle sales is the proxy. For the production of the vehicle manufacturers, we say that the motor vehicles assemblies are the proxy. For the tier 1s, we can say that the industrial production of vehicle parts is the proxy, for example. And then we can really monitor how the evolution is occurring in that supply chain or that value chain. So what we see here is if we monitor those proxies, is that you can see that at the start of 21, we see that there's been a substantial increase in vehicle sales. But we see that the production of and the assembly of vehicles and the production of parts simply not following that behavior. So that there you can really monitor that there is a lot of demand going on at the downstream side of the supply chain, whereas you can see that, well, automotive producers, they simply don't produce vehicles enough to fulfill that demand. And that's then something that we see in our next monitoring dashboard. And so we see that inventory levels, that's the green line of finished cars are at an all-time low, whereas the number of parts going into that supply chain is actually at a very high level. So we see that the supply chains of automotive value chains are absorbing a lot of parts, but they're really not making a lot of or finishing a lot of vehicles. So inventory levels are at an all-time low, actually. And that, of course, has an effect on prices. So we see that consumer prices of cars, of new cars, but also, for example, of used vehicles has really skyrocketed over the past year. For example, used cars has increased, the price of used cars has increased with 50% over the past year. So that's a really impactful increase, which is also very interesting to monitor, because if you see that shortages are decreasing, you would expect those value chains to be normalized. So as a wrap up of this presentation, inflation has many downside risks, also some upside risks for companies. But what you can do about it to monitor is to really map out value chains, determine what is your position in this value chain. Do I have a strong bargaining power over my clients, over my suppliers? And you can also attempt to monitor their behavior on the demand side, on the inventory side, on the price side, on the order side, by creating monitoring dashboards. And if you're willing to go, for example, a step further, then you could really include those indicators in a forecasting model. For example, this model which we built here predicts an automotive sales time series by looking at, for example, leading indicator called vehicle sales, which is leading 3 months here, together with consumer confidence, which is leading 5 months. So I still see that we have 5 minutes for questions.
Yes, so Gillian, I received a question from the audience. It was more to your explanations about inflation, because one person observed like this seems to be endless, this wave, also with the daily messaging around it. And how does this end, or is this only the beginning? What's your assessment on this type of situation?
Yeah, that's a very interesting question. The way I see it, if there's increased appetite for certain goods, then typically after a period of time, companies, they will increase their production capacity. For example, with the chip shortage, companies or countries are actually investing. Also, companies are investing a lot of money in their chip making capabilities. And we see automotive companies actively designing chips. So I think in the end, the problem will solve itself once there has been built enough production capacity and knowledge by companies, by countries, to produce several types of goods. Of course, for semiconductors, it's not that easy to just say, okay, we're going to buy or build semiconductor plants. So it might take some time for the situation to normalize, but I think in the end it will normalize.
Let's hope for that. I have another question. It's you were mentioning the margin squeezes, I read here, and the question was, can you elaborate a little bit more on this margin squeezes and this cost inflation for companies?
Yes, indeed. For example, I think companies have seen costs increase substantially. Raw materials, as we have shown in the presentation, those costs those prices have risen dramatically over the past year. So we see that, for example, wood prices have increased substantially. Steel prices have also increased dramatically over the past year. So the question is then, can you pass this cost further up in the supply chain? We see that, for example, IKEA is able to pass those costs onto their customers, which is the consumer. But if you're, they might also be able to reduce the impact of their raw material cost increases because of their size and their bargaining power. However, if you're a small producer of furniture, or you're a small store of furniture, then you might find it a lot more difficult to pass on those cost increases or to block those price increases in your value chain.
Okay, thanks a lot. So if there would be any questions from the audience towards Solventure, please contact Gillian or myself. Thank you very much for attending the session, and we hope to see you next time in our following webinar. Thank you very much, and bye-bye.